It's a familiar story, isn't it? The rent is due and it's somehow gone up again. Your landlord, who you've probably never met, just sent an automated market adjustment email. It feels like the American dream is turning into a subscription you can't cancel. You might blame inflation, your city's popularity, or your avocado toast habit. But what if the real reason is more corporate? What if your landlord isn't a person at all but a massive, faceless financial entity? A new kind of landlord has moved in, not buying a duplex, buying entire neighborhoods. These are private equity firms, Blackstone, KKR, and they have discovered that single-family homes are a fantastic way to make money. They're not in the business of building communities, they're in the business of building portfolios. For them, your home isn't a place to raise a family, a place to grow old. It's an asset class, a line item on a spreadsheet, a reliable source of revenue. These firms don't play by the same rules. They come with billions in cash, outbidding families, outbidding first-time homebuyers with offers that are impossible to compete with. They then turn around and rent those very same houses back, but with higher rents, a laundry list of new fees, and a property manager who is likely an algorithm in another state. It's a perfect, profitable loop for them, and a frustrating, expensive trap for everyone else. So, how did we get here? How did Wall Street become Main Street's landlord? It's a story that involves complex financial engineering, clever political maneuvering, and the exploitation of a housing market that has been broken for a very long time. It's a story about how your own retirement savings might be funding the very system that's pricing you out of a home. We're going to untangle this web, because understanding the problem is the first step. And believe me, when you see how the whole system is set up, you're going to want to do more than just understand it. You're going to want to change it. The term private equity gets thrown around a lot, usually by men in expensive suits with Bluetooth headsets. It sounds intimidatingly complex, and that's by design. But at its core, it's surprisingly simple. Think of a private equity firm as a company that buys other companies. Instead of using all its own money, it uses a lot of borrowed money. A leveraged buyout. It's like buying a pizza with a 90% off coupon, except the coupon is a massive loan. The pizza might be a chain of nursing homes or your local hospital. Once they own the company, the goal is to make it as profitable as possible, fast. That often means aggressive cost cutting, firing people, reducing services, and loading the company with debt. After a few years of this financial liposuction, they sell the company for a profit, pay back the loan, and walk away with a fortune. After the 2008 financial crisis, millions of homes were foreclosed and prices plummeted. Private equity saw opportunity. Use LBO tactics not just on companies, but on thousands of single-family homes. They put down a little cash, borrowed the rest from big banks, and went on a historic shopping spree. First step, bundling. Rental income from thousands of homes gets packaged together. That bundle becomes a rental-backed security, essentially a bond. The firm slices and sells that bond to investors around the world. Wealthy individuals, university endowments, pension funds. Those investors are promised a steady stream of income, funded by you and thousands of tenants paying rent every month. Your monthly payment becomes a globally traded financial instrument. Your lease agreement is folded into international finance. Here is where the story takes a truly mind-bending turn. Who are the biggest investors in these private equity real estate funds? In many cases, it's you. Or more precisely, it's your money, managed by large institutions. Take public pension funds. The massive retirement systems that manage the life savings of teachers, firefighters, police officers, other public servants. Systems like CalPERS in California, the New York State Common Retirement Fund, are gigantic investors. They're constantly searching for stable, long-term returns to pay out future benefits to retirees. To these pension fund managers, private equity's rental housing operation looks like a dream investment. People will always need a place to live, right? So, rental income seems like a safe, steady bet. As a result, they pour billions of dollars of public employees' retirement money into firms like Blackstone. The profound irony is that the retirement funds of hardworking people are being used to finance a system that makes housing less affordable for those very same people. A teacher in California could be struggling to pay her rent, while her own pension fund is invested in the company that keeps raising it. This isn't hypothetical. In 2018, California had Proposition 10, which would have allowed cities to expand rent control. Blackstone spent millions to defeat it. But that money didn't come from Blackstone's corporate account. It came directly from its investment funds, the very funds financed by California's public pension systems. So, California's teachers and city employees unknowingly pay to defeat a measure designed to help them. And it doesn't stop with pension funds. The endowments of elite universities like Harvard and Yale are also major players. Your money, whether it's in a pension, a university you support, or a charity you donate to, could be part of a vast interconnected web that is actively working against your own financial interests. It's a financial system that has become a snake eating its own tail. So we're left with a housing market that feels fundamentally broken. Blaming private equity for creating the crisis is too simple. They didn't start the fire, but they absolutely poured gasoline on it, exploited it for profit, built a system to ensure it keeps burning. The question now is, what do we do about it? How do we fix a problem this big and this deeply embedded in our financial system? There's no single magic bullet, but there are clear paths forward to restore balance and make housing a place to live again. First and foremost, the solution must involve supply, but the right kind of supply. For decades, the United States has chronically underbuilt housing, especially smaller entry-level homes that first-time buyers can afford. We need to reform restrictive zoning laws that make it difficult to build anything other than large, expensive single-family houses, policies to accelerate permitting, incentivize affordable multifamily construction, and support innovative housing models are crucial. Simply put, build more homes, especially starter homes that Wall Street targets, so families can compete. We also must change the rules to level the playing field. Discourage bulk buying by institutional investors via transfer taxes or other regulatory measures. Strengthen tenant protections nationwide. And it absolutely means closing the carried interest tax loophole. A private equity partner making millions flipping homes should not pay a lower tax rate than a teacher or firefighter. Make them pay their fair share. It would generate billions and reduce extractive incentives. Ultimately, decide what housing should be. Is it a financial commodity for global investors, or a human need and cornerstone of stable communities? We can't be passive while Wall Street financializes our roofs. This requires political will, public pressure, and a clear-eyed understanding the system fails most Americans. The path forward won't be easy, but if we don't start walking it, we risk waking up in a future where the American dream becomes a luxury available only to the highest bidder.